the subject of our webinar today is how to sell credit spreads for extraordinary profits. And credit spreads have gained a lot of popularity lately, and I just want to show you some kind of unconventional ways to sell them and some things that you can do that can really greatly increase your returns without increasing your risk. And so Reed did a fantastic job of introducing me, but I just want to show you a picture so you know who's talking. And I have a company called Cash Flow Heaven Publishing, and the purpose of that company, I'll just tell you really quickly, is to help you generate enough cash flow from the markets and from more passive ways to make money so you don't have to concentrate so much on your labor to make your daily bread. And I just tell people that I was blessed when I was young to have a whole bunch of really terrible jobs with a bunch of really horrible bosses. And at the time, of course, you don't think that's much of a blessing, but in looking back at it, they really gave me a lot of great motivation to go out there and try and find some forms of income that didn't have anything to do with me trotting off to a job. And I got so passionate about that. It's so liberating when you start having some of that money coming in. I decided way back in the late 1990s to start a company that was dedicated to just that. And one of the cool things about this strategy is I think it's one of the most realistic, doable ways to start off with a small amount of money and build it into a pretty tremendous income. And so we're going to go over all of that today, and I think you're going to come away really, really inspired. So I'm excited to have you here, and I'm really glad I get to be the first speaker because I want to really get you some information that'll make you feel pretty inspired about your future here. So I just wanted to say, real quickly, what's your reward for learning something new? So when you're presented with some new information, you kind of think to yourself, is this worth my time? Is this, something I really want to put my brain power towards to really figure out how to do? And is it worth it? So we're going to explore that. We're going to talk about what the strategy is. I know, many are familiar with credit spreads. Some, not many, but some are actually doing them. And some of them just, some folks have a vague idea about what they are, and some have no idea. So I'm just going to really quickly go over what the strategy is and how to do it, what the average returns are, what you can actually expect, what most people expect. If you're to buy a book on the subject or to go to a seminar or go to one of the brokerages to try and figure out what the strategy is, what are they going to tell you average returns are? What can you expect? And then number 4, probably most important, is how to create extraordinary returns. So how can you take what unfortunately some consider kind of a mundane strategy? It's not one of these crazy wild Forex trades where you're doubling your money in 15 minutes, or even an options trade where you're trying to, just hit a big home run. This is just, money coming in, just week after week. It's actually really cool. But how can we take that strategy and create extraordinary returns with it? So we're going to just take a look at all of that. It's going to be pretty fast-paced. Like Reed said, if you want to take some notes, that might be a good idea, and we're just going to get right into it here. So first one, before we get into the details, let's take a look at why we're doing this strategy in the first place. What's your reward for learning something new? And I just love this little guy jumping up and down on a sack of money, because if you've ever made, really good money on a certain trade, you had a hunch, you did a trade, it worked out, and you just, it just really came through for you. You kind of feel like this guy jumping up and down on this sack of money, and I think for an awful lot of us, that's probably one of the big reasons we do like to trade, is we like to, get those big victories, and that's pretty darn fun. So we're going to take a look at what your reward is. And also, if you learn to bring in, we just touched on this briefly already, if you learn to bring in enough income that is not based on your labor, you'll be financially independent. And I think we all understand that. I think for an awful lot of us as traders, that's kind of our goal. So once you understand how to bring that money, in that money you can be financially independent for life. And one of the cool things about the internet and trading now is you can literally do that from anywhere. So I know the good folks that are putting on this presentation and this series today are down in Orlando, Florida. Absolutely gorgeous place if you've ever been there. A lot nicer than perhaps Minnesota in December, to be down in Orlando. So you can go down there and trade. You can go to Europe. If it's too hot where you live in the summer, if you're down in Arizona, you can go someplace beautiful and cooler. So a lot of freedom comes with trading. So to a certain extent, I know I'm kind of preaching to the choir here, and I know we sort of all agree on this. This is why we're traders in the first place. So I assume you're already trying to become financially independent. So how is this different than the trading you're already doing? How is this different than what the things that you're already doing? Why should you look at this? Why should you think about actually allocating probably the majority of your money to this particular strategy? So there's two really big differences. The first is your likelihood of winning, and this is huge. Now I want you to think about this next statement. New traders focus on how much they can make. Experienced professional traders focus on their likelihood of winning. So I remember when I was first exposed to options and first started trading in them back in the mid-1990s, when I heard about it, I went to a live event and the speaker was really excited and he was talking about all this money that you could make. And honestly, when I left that live event, that seminar, I thought my biggest problem in life was going to be figuring out, what color my Mercedes-Benz was going to be. And I soon found out that all these incredible lottery-style home runs that I was going to make with options for different reasons. The market zigged when it should have zagged. The Federal Reserve did something I didn't think they were going to. The earnings weren't as good as the company thought they were going to be. Whatever the reason, a funny thing happens on the way to the bank. And a lot of the time when you're a beginning options trader and you're trying to hit those great big home runs, or actually trading in any venue and in any asset, you can find out that it's a little easier to lose than you think. So what happens with people that decide that they want to stay in the game and become professionals and really trade long term is they really start looking at probabilities and their likelihood of winning. And it's a lot more mature way to look at your trades. And it's a way that you can actually stay in the game long enough to start making some really good money. So in this presentation, you're going to learn how to create an 82% to 92% mathematical expectation of winning on every trade you make. And I want you to think about that for a minute because those are some very specific percentages. So a lot of the time people get into a trade, and if somebody was to ask that person, well, what do you think your chances of winning on this one are? Well, they're going to say, well, pretty good. My chances of winning are pretty good. I've done my research. This chart pattern looks really good. This, chart usually goes this direction, a big percentage of the time. And that's kind of how we trade. But what's kind of cool about this strategy, what I think is really cool, is you can actually pinpoint to a large degree with a great deal of accuracy your actual percentage chance of winning. And if we could set our trades up to win 82% to 92% chance of winning on every trade, how many times would you be doing that trade? And I suspect that we'd be doing them a lot. Whether it be flipping a coin or doing some game in Las Vegas at a casino, if you could win anywhere close to these percentages, you'd be doing those trades a lot. So the second big difference is the ease with which you make your profits. So our goal when we set these trades up, and I'll show you how to do this, is a worthless, and that means a profitable expiration. So what's kind of cool about this is it's based on time and time decay. So we do absolutely nothing to make time go by. It happens all by itself. And I think for all of us, we have a little bit of a procrastinator inside of us. And in most cases, that's just a terrible tendency. People say, don't put off until tomorrow what you can do today. And we kind of beat ourselves up for letting some of our projects go on too long without getting started or without getting finished. And the cool thing about this strategy is we all, most of us are busy people. The days go by very quickly. And before you know it, boom, you've got another expiration Friday and you've got another really good payday. So that's something I like with this strategy. You don't have to do much to make this work for you. It just kind of happens once you put the trade on all by itself. So your trades are all stacked so heavily in your favor that in most cases, once the trade is entered, you don't need to do anything to win. It happens automatically with or without you. And I just love this little graphic here, how to make money while you sleep. That's something I think a lot of us have dreamed about. Ultimately, I mean, if you had the ultimate dream, how could you just lay down at night, take a nice little sleep, a nice little nap, and wake up richer than when you went to bed? So that's kind of what this is about, and it's another reason I think it's so darn cool. So it's not completely hands-free or hands-off, as you may suspect, but only about 2 positions out of 10 will need some adjustment, and that's not too many. Well, first of all, so what is this strategy and why does it work so well? It's an option strategy. Now, trading options, if you've traded options at all, it can be pretty darn exciting. But trading options the way most people do it can be challenging. Most people buy options on a stock they think is going to really move in their direction with the intention of making a killing. And we kind of look like this guy here with our big dollar sign glasses on, and we're just going to make all this money. It's going to be super exciting. Well, a killing is often what happens. Unfortunately, it's not in the way that they were hoping. And, like we talked about just a minute ago, you think you're going to make all this money. The trade's all set up. It's the perfect setup. You did all your research. And and sometimes you even go, hey, this is going to work so well. I don't have to do my usual trade management. I'm going to put double or triple or quadruple the amount of money on this one because it's a gold-plated lock. I'm going to make so much money, and sometimes you even do the calculation, figure out how much profit you're going to make when it hits your target, and you're just going to make a fortune on this one. And a strange thing happens out there in the markets. You can see a pattern that happens over and over and over and over, and for some reason when you do it, when you get involved, it doesn't work that particular time, and you lose. And it's so damn frustrating. And I love this couple here because even if you're not these guys' age or whatever, we kind of look like them sometimes when we're looking at our trades. When you wake up one morning, the market gaps one way or another, and you just get this huge shock. So what we're trying to do here is avoid those big shocks and start making some really, really consistent money. So when it comes to options, I don't know if you're currently trading options right now or not, but options are really, really cool. I've actually fallen in love with them. But they've got some interesting characteristics and statistics that I think it's really important that you be aware of before you dive in there and start trading. And if you're already an options trader, if you're trading options right now, you might find this pretty fascinating if you don't know this already. So there are many estimates as to the percentage of options that expire worthless every month, but most come in somewhere around 85%. And, CBOE disputes that claim, on the internet. They say, well, the people get out of them before they totally expire worthless, and they've got all these qualifiers, but basically, when it comes to time decay, most of these options, just all of them, are worth less than they were when they were, the time value goes away, and they estimate about 85% of them expire worthless. So think about that figure. The vast majority of options, 85% of them expire worthless. Now here's something to consider. According to the Options Clearing Corporation, over $1.2 trillion worth of options were traded last year. And this year is projected to be even higher. Because options are so versatile, because they can be used as a hedge, because they can be used to collect income on stock that you already own, because they can be used for speculation, they've just gotten more and more popular every year as more and more people realize all the things that you can do with options. So $1.2 trillion worth of options is a lot of options, and that goes up every year. That's a lot of dollar value. So if 85% of options expire worthless, 85%, where does all that money go? So this is a really, really good and interesting question to investigate, because back when I was trading a lot of directional options in the very beginning of my career, and I was going to make a home run on every trade, and I was going to bat it out of the park, and I was going to make all this money, and I had all these stars in my eyes, I started noticing my trades, and I started noticing, that a lot of them didn't work out. I would lose all my money. So in some cases, if you have an option that's kind of out on the money, you're anticipating it's going to be in the money, and then the stock gaps in the opposite direction that you think it's going to go, your option loses value so quickly. It happens so quickly that you don't even have a chance to recover. Your whole position is just virtually worthless, and you have no choice but to just kind of wait it out and hope something nice happens between that point and expiration. So a lot of money gets lost. So if I had, say, $5,000 in on a trade and it all disappeared, I thought, what in the heck happens to my money? Does my broker get it? No, he just collected the commission on the trade. Does the market maker get it down on the floor? No, they just make the difference between the bid-ask spread. So I'm thinking, is the money destroyed? Is it just like burned up, like it's in a fire and it just goes away? And I thought, well, no, that doesn't make sense. Somebody is getting that money. And I just pictured this huge pile of money, like going all the way to the sky. And I'm thinking, oh my gosh, who gets this? And maybe a more important question is Can I be the one? Can I get a little part or a little that piece of that mountain of money that's accumulating every expiration? And after a little bit of thinking, and you probably know the answer to this question already, but here it is. It's the money goes to the option sellers. The money goes to the option sellers. It's the people that are selling those folks the lottery tickets, the people that are trying to bat it out of the park, the people that are trying to turn a 75-cent option into a $5 option. Those are the people that are collecting the money. And you think to yourself, well, 75 cents doesn't sound like much. Well, you put a few zeros after that, and it can get pretty big, especially when you're consistently seeing that money hit your account. So there's some powerful reasons to become an option seller. And I think you'll begin to realize this the more you get into it. And what I've noticed is the people that stay in the options game, the people that end up trading options for a living year after year, and this guy, some neighbor or whatever, somebody that has this incredible lifestyle, and you go, what do you do? And they go, well, I'm an options trader. If you get in and you really start talking to them and find out what they do, invariably you'll find out that they're an options seller. So if that's what we want to be, what kind of options seller should we be? Should we do covered calls? Well, a lot of people do that, but you have to own the stock in order to sell a call. So that takes a lot of money. Even a $20 stock, for 1,000 shares is $20,000. That's a lot of money to have tied up to get a little bit of call premium. Should we sell naked options? Well, I'm not so crazy about that idea either, especially for any kind of speculation, because if the stock gets put to you and you're not expecting it, or if something gets called away from you, you can really lose a tremendous amount of money. Really, your loss potential there on the call side is infinite. On the put side, it's all the way down to zero, so it's really way too much risk, and your broker's going to make you set aside a lot of margin to do that trade. So, I don't like naked. I don't like naked options at all. So how about this third one, credit spreads? Now, credit spreads I found to be a super interesting way to trade. There's a lot of variables and a lot of things you can do with credit spreads, and with credit spreads, what's cool is you're protected on the downside on every single trade you make. You're hedged. So what is the credit spread? Let's just talk about that for a minute. And like I say, if you're listening right now and you're super familiar with credit spreads and you've been trading them yourself, the next 60 seconds or so you can kind of just skim over. But if you're not quite sure about this strategy, or if you're really curious, or you don't know about it at all, just pay attention for a couple seconds here, because I think this is absolutely incredible. So a credit spread is where you sell an option to collect the premium and then sell another option further away from the stock to hedge. And so the beauty of that is, in most situations, what people think of as selling premium, they think about owning the stock in order to do that, so you're covered. But in this case, you don't need to own the stock. So I'm just going to get my little pen here, my little red pen, and I want to point out some things. So what we're selling here in this particular case is, first of all, you want to look at the trade setup, and you see that there's this huge big uptrend here, and it's going up at a really good rate. Every time it hits its uptrend line, it bounces, and it sort of looks like this uptrend is going to continue. So you think, this looks like this stock is going to just keep going higher, or at the very least, go sideways a little bit. So we sell the 1775 put because it's in the opposite direction that the stock is heading. And so the whole object of this is to sell options that never get touched by the underlying. And so if the underlying is going away, in this case, in this direction, it's going away from what we're selling down here, there's a really good chance the underlying will never touch our sold strike. So in this case, we sell the 1775 for $5.20. We buy the 1770, so that's just $5 away, right down here, for $4.70. So the difference is 50 cents, and that's our credit, is 50 cents. So you go, well, what does this amount to? What do we have here? A 50-cent credit. Now, we can only lose the difference between these two strikes. That's all we can do. And so that leaves us $5 is our potential loss. And if we take our 50-cent credit away from the $5, we end up with a $4.50 possible loss. That's the absolute maximum that we could lose. Another way to look at that, conventionally, people look at that as our investment, the $4.50. So we take our 50 cents, we divide it by $4.50, we get an 11% return. So I want to point something out here about our probabilities before we get into specific percentages, but just in general when you take a look at this trade. And I want to direct your attention over to this statement right here. A stock can only do one of 5 things. So in this particular instance, one of the things I like is we always have a finish line. And that is right here. So that is our expiration date. That's always on a Friday. And we know how long we're going to be in this trade. So that's another thing I like. It's not open-ended. We know when our paydays are going to be or when our projected paydays are going to be. So let's take a look at this. A stock can only do one of 5 things. It can go up really radically, really fast. That happens sometimes. It can do kind of what it's been doing. It can go up more gradually. Another thing a stock can do, and we've seen several stocks do this, is they can trade sideways. That's kind of what this one has done for several days. It can go sideways. It can also go down, kind of drift lower, and we see that a lot, where a stock sort of rolls over, kind of like what it did here. It's not going down radically, but it's just kind of going down and heading lower. The other thing that can happen is, some really startling, frightening news can come out, and the stock can go down very quickly, very fast. So out of these 5 different scenarios that the stock can do, we're going to win on 1, 2, 3, 4 of them. As long as this stock crosses the finish line right here, without touching our sold strike, we win. So the only way that we can lose is if it does just 1 out of the possible 5 scenarios. So right off the bat, I really like those odds. Right off the bat, just really roughly, just a napkin kind of a, seat of the pants, you've got an 80% chance of winning and only a 20% chance of losing. So right off the bat, that's pretty good, but we can actually improve that substantially. So our likelihood of winning is great, but and this is if you're a good trader, you always want to know how much money can we make. What's our potential? What's our possibility? So when traders talk about credit spread returns, they typically think in terms of 5% to 10% per month. And that's really typical. And by the way, if you're used to really trading hot and fast and you want to double your money overnight and that's the kind of trading you do and you're really excited about that and that's really cool, you might take a look at this and go, well, 5% to 10% a month is nothing. I mean, that's almost like a waste of my time. Why should I even do that? Get out a calculator and start taking a look at what these returns add up to if you start getting them consistently and don't lose month after month. I think it's going to start looking a lot more interesting. So this is typical. These are average rates of return for credit spreads. So in our previous example, we got an 11% return, which is a great deal for the low level of risk we're taking. That's 11% in a month. But can we do better? And if you think about it, that's the purpose of this webinar. How can we get extraordinary returns? How can we get really great returns without increasing our risk? Well, the first way, what if we could double our returns while keeping our probability of winning the same? Doubling your return sounds pretty good. So the first thing, and if you're familiar with credit spreads, you know this, but I still think it's really cool, is we can sell another spread. So we see that this is kind of contained, kind of going like this, and even at the projected rate of increase, we feel that this will, even if it keeps going up, it'll still cross our finish line right here without touching this set of strikes. So when you have 2 strikes right here and you have what's called a spread, a credit spread, this is called a wing right here. This spread is called a wing. We've got another wing down here that we already put on, as you remember, for 50 cents. So we put this spread on up here. We sell the 1885 and buy the 1890 to hedge, and we get another 50 cents. Well, so here's what's kind of cool that's happened in the last few years with options brokerages is in the old days they used to make you hold the margin for both of these spreads. So they make you hold $5 on one side and $5 on the other. Well, that really ties up a lot of your money. Well, the problem is with doing that is there's no way that the stock can close above this set of strikes and below this set of strikes at the same time. It's either going to be above one or below the other, or in between them. Those are the only things that can possibly happen here. So the cool thing is brokers now only make you set aside the one margin, or $5. And so since we got 50 cents on this down here, the put spread, and we got 50 cents on the call spread up here, we actually end up taking in $1. And since we subtract that dollar from our $5 potential loss, now our potential loss or our investment is only $4. So take a look at this. $1 divided by $4 is now 25%. And if you can get a 25% return every month, and you can do that with an 80 to 90 or an 82 to 90% probability of winning, there's a really good chance you're going to end up rich. You're going to end up wealthy. And this is kind of what we're shooting for, is this 25%. And there's a lot of ways to get those kind of returns, and in some cases even better. So let's take a look. A 25% return, in this case, we sold 3 weeks. For just 3 weeks of time is huge. But if you're a good trader, you've had some experience and you've been around a little bit, right about now you might be thinking, you know, that all sounds good. Everybody that talks about these new strategies, they always talk about the upside and all the good things that can happen. But I've been around the block a couple of times, and I know what the stock market's all about, and you can really get dealt some surprises. So what happens if the trade goes against us? What happens then? What do we do then? I get the downside or the upside. The upside's great, but I'm a little more concerned about the downside. I want to protect my money. So how do you defend against a trade going against you? So there's a lot of ways to do that, and I put together this fantastic educational package, and a really big percentage of the package is dedicated to what they call adjustments. So that's exactly this, and what an adjustment is what happens when a trade goes against you. How do you defend yourself? Now, keep in mind this only happens about 2 out of 10 times, but it's a really important 2 out of 10. Because if you know about credit spreads, and if you've done a little analysis, you know that you can actually lose quite a bit more than you can make. So in our previous example, even though we could make $1, we could potentially lose $4. Well, we never, ever want that to happen. And fortunately, there's some things that we can do to prevent that from happening. So if you're a spread trader, a credit spread trader, and you just follow what I show you in this educational material, you should never, ever, ever have 100% loss. It should never happen. So let's take a look at a scenario right here. Say this is going up, and you've got this uptrend line, plus you have a couple levels of pretty strong, so you have our up, for those of you that are technical traders, we've got some uptrend support right here that looks pretty strong, plus we've got horizontal support that in this case, once resistance is broken, it turns into support. That's what's happened here. So we have some good horizontal support here. We have some more horizontal support here. And so we sell our spread below that, below all of this support. But you know what? Something comes out, something happens on the other side of the world. There's some political unrest. The Federal Reserve or the FOMC decides to do something that was unexpected by the market. Whatever happens, or whatever the scene or the scenario, all of a sudden this thing just starts falling like a rock. And our spread down here is really threatened. What do we do? And you do need to take action. So this is really simple. Now this is a really simple adjustment. I've got a whole bunch of others that are super, super cool. But I want to show you at least one just to alleviate some of the fear you might have about putting on spreads. So what this is close and roll to another condor. So what you do is this is your spread that's threatened right here. So you close this spread, and it's going to cost you some money to do that, because the closer the underline gets to your spread, the more expensive it is to sell. So it costs us a few bucks to close this spread, and we're not in the business of losing money. We're in the business of making money. So what we want to do is bring in some more money to offset that cost. So we can close this, and if we want, we can also close this for almost nothing because the underlying is so far away from it. And then we open a new spread, so the stock is right down here close to our sold strike. We open a new spread here and a new spread here, and you can see what we've done here is sort of position our wings sort of at the midpoint of where the stock is now. A lot of the time when you have a big sell-off, you'll get a little bit of a bounce, you'll get a little bit of congestion that happens. Sometimes you'll get a little bit of follow-through that kind of mellows out a little bit. But the point is you've now got more time to be right. And you've taken in bigger credits. As you can see, our finish line was here. Now we've sold perhaps another week to give us a little bit more time, a little bit more premium, and you've actually end up with a positive, or at least a break even, on a losing trade. Now I want you to think about this because, just about all the trading out there that's directional that I know about, the best you can do is put in a stop loss. And so if the trade goes against you, you stop out at a loss, and you go, well, that one didn't work out, hopefully the next one will work out better. This is the only form of trading that I know of that you can actually have a trade go radically against you. So out of those 5 scenarios, you get the absolute worst one. You get number 5, where the stock goes just radically against one of your spreads and absolutely threatens it. And here's a very simple technique where you can go in, close your spread, and open 2 new spreads, and actually bring in more money than what it cost you to close, and now you've got a chance to win on the trade. I don't know of any other trading that you can do that. So if you think about this for a minute, you're already starting off, if you do this the way I'm going to show you here, with an 82 to 92% chance of winning on every trade. So already you're going to win on about 8 out of 10 trades. And then on the 2 that you do have to adjust, you have an opportunity, another chance to be right. So you can see it's going to take an extraordinary event. I mean, the market is really going to have to move radically in one direction very, very strongly for quite a while in order for you to really be in a position where you lose money. This is another huge advantage of trading this way. And like I say, if you like your speculative trading and you like the thrill of the game and you like to get into these trade setups and you're really nimble on your mouse and that really, feeds your spirit and you really like making money that way, I'm not going to try and talk you out of doing that. Keep doing that. That's really cool. What I am going to try and talk you into doing is taking about 80 or 90% of your tradable assets and put them in a strategy like this where you have such incredible high odds of winning. And then take 10 or 15%, whatever you're comfortable with, and go over there and do your, your gunslinger trades that are so cool that you like so much. Keep doing those, but do those with a much, much smaller amount of your capital. What you'll find is a lot fewer disappointments, and you'll start to see your brokerage account really build. So I love this picture. But what happens if disaster strikes? What happens if the stock really gaps big against it? So for you, the folks in the crowd that are always, looking at, what's the worst case scenario, what's the worst thing that can happen, and you're saying, yeah, you're painting a really pretty picture, but I want to know what happens when things really go haywire. And you know what? If you've been in the markets for a little while, you know they do. Occasionally, it just goes crazy, and you feel like this kid in the picture. You're just going, oh my God, You wake up in the morning, you come out, you look at your screens, and there's been a huge gap. There's some big news that happened overnight. There's been an invasion somewhere, or something's happened, and there's a big gap, and you've got all these spreads on. What happens? I'm going to show you right now a worst-case scenario that actually happened. Fortunately, we have to go back a while. I had to go all the way back, quite a while to find this trade, but here's an actual trade. Here's my actual commentary. So this is what it looks like when I show you a spread, or if you subscribe to the service, and this is what you're going to get. I think it's really kind of cool to see what you're going to get before you get it. So CF it's a fertilizer company. They're nice and inexpensive. I like to trade expensive stocks. They have good premiums. So here's the actual commentary. CF is rising in a gradual uptrending channel, which will be selling well outside of for some generous high odds premium, and that's true. We collected some good money on this one. You can see the uptrending channel. It's very consistent. It hits it. It bounces off. This is coming down here. We're anticipating, it's going to go down and bounce off of that and stay in this channel and expire comfortably between our 2 spreads. So these are our spreads. You can see them. This is a 205 according to the chart here. We hedged with a 200. We sold a 230. We hedged with a 235. So this is a $5 spread. We brought in some good premium. Trade looks good. Everything's good. Except occasionally in the markets you can get dealt a wild card. And here was our wild card. We weren't in the trade very long, maybe about 3 or 4 days here. And some news came out that CF was thinking about converting from a corporation to a master limited partnership. And master limited partnerships have been super, super popular the last few years because all the boomers are wanting income. And MLPs pay a lot of income. And so this news was perceived, with just giddy delight, ecstatic, exuberance by the markets. And overnight, take a look at this gap. Take a look at this. The stock gapped up over $30 in one day, rocketing right through our spread. So if you're a spread trader, would you agree with me? This is just about the worst case scenario you can get. It started off down here the night before. Our spread was looking just fine. I think this is probably around 214 or so is where it closed the night before. And it gaps up all the way to about 225 and then just keeps on going. So here's what we do to be prepared for any worst case scenario. So one of the things that we do, which is a great thing to do, this gives you a lot of peace of mind and really helps you sleep at night, is as soon as we put on these trades, we enter automatic orders that, the brokers now have such fantastic software. And the broker that I use and I recommend for everybody is Thinkorswim. You can actually, they have decent commissions to start off with, but if you're trading a lot of contracts and you have a decent size account, you can actually negotiate lower commissions. So the commissions are good, but what I really like about Thinkorswim is their trading platform. You can do some incredible things on their trading platform. And one of the things that you can do is you can enter automatic orders that are if-then type orders. So this if-then order is if the underlying, if CF stock hits $2.30 a share, immediately close my spread, close it at the market, and do that instantly. So you can see the stock gapped way up here and started moving up, and the minute our sold strike was touched, we closed this spread. Now, obviously, it cost us a lot of money to close that spread. Volatility was through the roof. The underlying is now touching the strike. Yeah, it was expensive. And so it gapped up here one day and then sort of came back and retraced slightly the next. So what in the heck do you do in this situation? How do you turn a disaster, something this horrible, this bad of a surprise, into something good? Because I'll tell you what, if you were betting directionally, if you were betting straight puts here and you said, oh, this thing's going down, I'm going to buy some puts on it, this looks like a good trade, and the night before you got a big down red candle and you thought, this trade's working out pretty good, and you woke up the next morning, there is no escape. If you're trading directional options, you're toast. You've just lost your money. And a gap this big, you're not even going to be able to get stopped out at much. So what are we going to do as spread traders? What can we do in this scenario? Well, here's what we actually did. So this top spread, it cost us $2.20 to close the spread. A lot of money on a $5 spread. That was very expensive. We closed the bottom spread because the underlying was so far away from it at that point, we closed it for just 10 cents. So it cost us $2.30 to close both spreads. But then we sold two new spreads. We went way up here, didn't look like, with this little bit of retracement here that we had already seen, didn't look like it was going to keep climbing. And it also didn't look like, the gap was going to get filled in this amount of time, and the volatility was really high, so we got some really good premiums. So we opened two new wings. So our two new spreads, we got $1.74. So here's how the math on this works out. Our total credit, our first credit that we got for selling the two spreads in the first place is 85 cents. And our second credit that we got for selling these green spreads, we saw, and you see it's still the same expiration. We didn't have to go out any more time because the volatility had gone up so much. These premiums are so juiced at this point that we can get so much premium that we can do this trade and take in $1.74. So our original 85 cents plus $1.74 is we got $2.59 in credit total for opening all these spreads. But it also cost us some money. Remember, it cost us $2.20 to close the threatened spread, and it only cost us 10 cents to close the spread that's further away. Well, that's a total of $2.30 is what it cost us. Well, if you subtract $2.30 from our new, our total credit of $2.59, you get a 29-cent credit is what we're left with. And sure enough, the thing bobbled around, it retraced quite a bit and then came back up, went right between our two new spreads, and it ended up expiring worthless. So we didn't make quite as much money as we thought we were going to do, but here's the incredible, amazing, awesome thing about this trade that should really hit home, is we didn't lose money, we made money. We ended up making 9% on a trade that was just about as disastrous as can possibly be. So right about now you might be thinking, well, that's pretty incredible, but I'm a trader, I've been down this road before, I know for a fact you can lose money. I don't care what you say, I don't care what fancy technique you have, you can lose money. And you know what? You're right, you can. There's some scenario out there sooner or later is gonna, is gonna take a little bit of money away from you. But what if, that's trading? I mean, we all know that being in this game. We know that we're getting paid to take on a certain amount of risk. So I'll give you that. Yeah, there is some scenario out there where you can lose money. And if you look at our track record, yeah, we sometimes have losses. But, most of the time you win. So Joseph just sent me a little message, and he says, and I wanted to just show you this and kind of how the math breaks down. Here's our first two spreads, and then we came back with these two spreads, and we ended up with this, and this is right off of our public track record, and you can actually see this. Joseph just sent me a message, and he said, I thought I had an hour, but it's really 45 minutes, so I'm just going to kind of wrap up real quick here. The beautiful thing about credit spreads is you have options. There's almost always something you can do to make a trade better. I'm just going to go through this really quickly. How can we really create extraordinary returns? So this is where you want to take notes. There's 5 strategies to really, really increase your returns without increasing your risk. Pick the highest odds underlying. We usually do indices versus stocks. There's a great time to do stocks, and that's right after they've announced and they've really moved. The volatility is high, but the risk is low. Sell outside the predicted range, paying attention to market direction, individual trend, and future events. I'm going to go really fast here because we have limited time. Make sure your probability of winning is 80 to 90%. I can show you how to do that. It's all based on the Black-Scholes pricing model. Right here in the Thinkorswim platform, you'll see where we put on this trade, and we have about an 84% chance of winning. That's where we want to be. The time decay curve, this is one of the biggest secrets I'm going to give you here, is I've done a ton of research. You can see how flat the time decay curve is there out 2 months and 4 months. It doesn't start to steepen up until the second month. Here's where we sell. 1.5 to 2.5 weeks. It's the absolute best time to sell, and you'll get the most money for your spreads. Get bigger credits by selling your wings at different times. Super, super important. You can see we put this one on here, and then the stock went down. We put this one on here. This is an amazing trade. This is one we actually did. We got $1 on this side, $1 on this side for a 67% return. And our target's 25%. Here's a recent track record, 25, 23, 35. These are extraordinary returns in the credit spread world. If you take a look at the times that were involved in these, they're about 2 weeks, not a month, because of weekly options. If you compound even just 5% a year, you'll grow 10,000 into 32,000 after just 1 year, and after 2 years you'll have over 104,000 and over 10,000 a month. So listen, I want you to have everything you need to be successful at this. I've got to wrap up here in about the next minute, but I'm going to give you an opportunity to get an incredible package and trade with me. And I'm doing this in my Roth IRA, and all the profits, all the buildup is tax-free. It's so incredibly cool. You can do this in a Roth if your broker thinks you have options trading experience, and by the time you get my package and learn this, you'll have all you need to know. So this is the website is profitcollector.com. I've got an incredible package. It's got gosh, 162-page digital book with color charts, graphs, everything you need. I've got videos. I've got about 15 videos in there. I've got 14 audios you can listen to in your car, download to your iPod. This is all things that you can keep. I've got a beautiful library of webinars in there that teach and really show you what to do. I've got an incredible package called the Automatic Money Machine that shows you how to set up your trades automatically so you don't have to worry about them. And I've got a whole package on the weeklies, just on trading the weeklies, that we've sold all by itself for over $200. People absolutely love it. This whole package is $395. A subscription to the service is $97 a month. Trades come out every Tuesday evening. We're very successful. I want you along with me, but I'm going to put both of those together, the subscription and the package, for substantially less for you being a part of this this presentation today, I really want you on board. I'm not so concerned about making so much money off of you. What I really want to do is for us, you and I, to make some really good money together. And I'm convinced this is the way to do it. It's the most forgiving strategy out there, and it's also one of the most profitable if you do it right. So this is the URL. I want you to just take a quick minute to go there, sign up for the special. I've got a combination of the subscription and the educational package. I just want to mention the educational package alone I used to sell for over $2,000 at live events, and I still get thank you emails from people that are trading it years later. This is probably the shortest path between you and a really generous, carefree retirement, no matter what age you are.